Hello everyone, my name is Dr. N. Krishnan, Assistant Professor of Economics, V.O.Chidambaram College, Thuthukudi. On behalf of V.O.Chidambaram College, I welcome you all to watch this class. Today we are going to discuss about wages. We will see the following main headings, that is meaning of wages, definitions, concept of wages, types of wages and theories of wages. Wages. This topic is very important in microeconomics subject. Firstly, we can see meaning of wages. Wages are the remuneration or reward for labor. In other words, wage is the price paid to the laborer for the services rendered by him. Wages are a payment for the services of labor, whether intellectual or physical. Wage may be paid daily, weekly, fortnightly, monthly or yearly and quarterly at the end of the year in the form of bonus. In economics, the price paid to the labor for its contribution to the process of production is called wages. Wage is the income derived from human labor. It is the compensation made to the employees for either physical or mental work. Wage is a payment for hired labor paid on a daily basis or weekly basis, while salary is a payment for white collar jobs paid on the monthly basis. Next, if you see the definitions, Bencom defines wages as a sum of money paid under contract by an employer to worker for services rendered. According to A.H. Hansen, wage is the payment to labor to its assistance to production. Next definition given by T.R. Turner. According to T.R. Turner, a wage is a price. It is the price paid by the employer to the worker on account of labor performed. Next, concept of wages. There are two main concepts of wages. That is, first one is nominal or money wages. Second one is real wages. Firstly, we can see nominal wages or money wages. Nominal wages refer to the wages paid in terms of money, that is the remuneration received by the labor in terms of cash is called nominal wages or money wages. Second, real wages. Real wages are the purchasing power of the money wages. In other words, real wage refers to the goods and services which the laborers enjoys by the money wages. That is, it depends on the price level. If the price is high, the purchasing power is low and hence the real wage is low, and vice versa. Factors determining real wages. Factors like purchasing power of the money, methods of payments, extra earnings, nature of job, working conditions, period and cost of training, regularity of job and social prestige. So those factors are determining real wages. Next, we can see types of wages. Piece wages. Wages that are paid on the basis of quantum of works are called piece wages. Next, time wages, paid for his services according to the time. Cash wages, paid to the labor in terms of money. Next, wages in kind, paid in terms of goods rather than cash. Contract wages, wages are fixed in the beginning for complete work. Next, minimum wages, the minimum amount of compensation an employee must receive for performing labor. These are fixed by the state government with regard to industries, and the employer has to pay at least this much of wages. Generally, wage is based on recommendation of a wage board. Next, living wages. It is based upon the cost of living in an area rather than an arbitrary minimum. Next, fair wages. It is mandatory minimum wage set at rates which are very similar to those paid to unionized labor doing the task in questions. It is an adjustable step that moves up according to the capacity of the industry to pay and the prevailing rates of wages in the area of industry. The Fair Wage Committee appointed by the Government of India, the committee recommended that it should be above the minimum wage and below the living wage. Next, theories of wages. There are 12 important theories of wages. First one is subsistence theory of wage, the standard of living theory of wage, wage fund theory, the residual claimant theory of wage, the marginal productivity of efficiency theory of wage, discounted marginal productivity theory of wage, bargaining theory of wage, behavioral theory of wage, surplus value theory, and purchasing power theory of wage. Next, comparative advantage theory, and last one is demand and supply theory of wage. Now we can see it one by one. That is subsistence theory of wage. This theory is one of the oldest theories of wages. It was first explained by the Physiocratic school of French economists and was commonly accepted during the 19th century. The German economist lastly called this theory as the iron law of wages or the Bayesian law of wages. Karl Marx made it the basis of his theory of exploitation. Ricardo's name is also associated with it, though he didn't agree entirely with it. This theory is based on Malthusian theory of population. As we all know about the Malthusian theory of population, that is, population grows geometrical progression and food supply grows arithmetical progression. So there is imbalance between food supply and population. So wage must be equal to the subsistence level of the laborer and his family. Subsistence means the minimum amount of food, clothing, and shelter which a worker and his family required for existence. This payment is also called subsistence wages. It refers to minimum wages. Assumptions of this theory: if workers are paid more wages than subsistence level, then increase in workers and wage will come down. Next, if workers pay less wages than subsistence wages, it leads to decreases in worker and wage rate go up. So minimum wage is to be fixed. Next, second, the standard of living theory of wage. This theory is an improved and refined version of the subsistence theory of wage. Wage is equal to the standard of living of the workers. If wage is high, the standard of living will be high and vice versa. It means the amount necessary to maintain the laborers in the standard to which he is accustomed. Next, third, wage fund theory. This theory is associated with the name of J.S. Mill, though Adam Smith period of 1723 to 1790 in his book of Wealth of Nation also mentioned it, but credit goes to J.S. Mill, who perfected this theory. According to J.S. Mill, wages depend upon the proportion between population and capital. Every employer will keep a given amount of capital for payment to the workers. It is known as wage fund. It is fixed and constant. Wages depend upon the number of laborers. If we see the following formula, that is wage rate equal to wage fund divided by number of laborers. Next, assumptions of wage fund theory. Workers were paid out of fund. Funds are created by savings, demand for labor, and rates of wages depend upon the size of funds. If funds are larger, wages will be high. Fourth, the residual claimant theory of wage. This theory was propounded by the American economist F.A. Walker. Wage is the residual portion after paying the remuneration of all other three factors, namely land, capital, and organization and entrepreneur. In other words, wage is equal to the value of the whole product minus rent, interest, and profit. Assumptions. There are four factors of production, namely land, labor, capital, and organization or entrepreneur. Once all three factors are rewarded, what remain left is paid as wages to worker. So it is called residual claimant. The marginal productivity of efficiency theory of wage. It is developed by Phillips Henry Wicksteed and J.P. Clark of USA. According to this theory, no employer will pay higher wages than the marginal productivity of the laborer. If we defined marginal production in terms of physical units, it is called as marginal physical product, that is MPP in shortly. The marginal product is multiplied by the price of product and its marginal revenue is called value of marginal product, VMP. Under preferred competition, marginal revenue equal to price. Assumptions. Wage is determined based on the production contributed by last worker. This theory assumes that laborers are homogeneous. This theory is based on the perfect competition in the labor market. This theory is based on law of diminishing returns. This theory is based on full employment. Say for example, 20 workers produced 500 units, whereas 21 workers produced 540 units. So therefore 540 minus 500 equal to 40. So rupees 40 paid to worker. Next, sixth, discounted marginal productivity theory of wage. American economist Taussig, who gives a modified version of the marginal productivity theory, wage represents the marginal discounted product of labor. Wage is equal to the marginal product of labor minus the amount discounted. Seventh, bargaining theory of wage. Adam Smith had anticipated the bargaining theory. John Davidson, Dobb and Webb were the main economists in this theory. Nowadays, wages are determined by the collective bargaining. Assumptions. Fixation of wages depends on worker bargaining power. If worker bargaining power is strong, then tends to be high. If employer plays strong role in wages, then bargaining power tends to be low. Eighth, behavioral theory of wage. It is based on research studies and action conducted. It is based on elements like employees' acceptance to a wage level, prevalent internal wage structure, employer consideration on money, wage and salaries as motivators. The workers and the employees negotiate to determine the wages and the hours of work. Next, ninth, surplus value theory. This theory was developed by Karl Marx 1849 to 1883. Karl Marx is well known for his advocacy in the favor of labor. Assumptions. Like other article, labor is also an article which could be purchased on payment of its price, that is wages. It could be purchased on payment known as wages. After payment, surplus income is left with owner. So surplus income goes to owner. 10th, purchasing power theory of wage. It is developed by Figon. This theory concerns the relationship between wages and employment and the business cycle. Wage is not only the cost of production but also an income to the labor. Next, 11th, comparative advantage theory. It is related to international trade based on David Ricardo. Wages are based on productivity, thus in the country that is more productive, workers can get higher wages. And lastly, demand and supply theory of wage. This theory was developed by Albert Marshall. The modern economists propounded this demand and supply theory of wage. This theory takes into account both marginal productivity of the worker, that is demand side, and the requirements maintaining the present standard of living of the workers, that is supply side. According to modern economists, the wage rate depends upon the demand for supply of labor. The wages will be determined at a level where supply curves meet the demand curve, that is equilibrium point. In other words, like the price of the commodity, the price of labor, that is wage, is determined by the demand for and supply of the labor. So this is all about wages. I hope you got it and it will be very useful. So thank you, all the best. Thank you one and all. Thank you.